If Kamala Harris's tax plan goes into effect, it will result in new tax deductions, new tax credits, and increased taxes for certain individuals and businesses. Which means that if you are not aware of these potential changes, you could end up overpaying on taxes if you do not plan for them in advance. So, as a licensed CPA that has fully reviewed her tax proposal, and as someone who tax plans every day at mycpacoach.com, I want to give you a very simple understanding of the major changes she is proposing, and more importantly, how you can take advantage of them if they go into effect. Okay, so there's two things going on here. First, most of the tax cuts that were introduced in 2017 are set to expire after 2025, which means if nothing changes, taxes will increase for everyone. For example, the Tax Cuts and Jobs Act nearly doubled the standard deduction for all taxpayers. It introduced the QBI deduction, which grants a 20% write-off to eligible small businesses. It also increased depreciation limits, which virtually allowed investors to write off up to 100% of their investment property. And then it also decreased the corporate tax rate from 35% down to a 21% flat tax. Now, all of these provisions lowered taxes for people across the board. But if these tax provisions expire, taxes will increase for most taxpayers regardless of your income. However, Kamala Harris has stated that her administration will ensure that no one earning less than $400,000 per year will pay any more taxes, which implies to me that they may keep some of the 2017 tax cuts, such as the standard deduction, for example. And personally, I work with a lot of small business owners who would love to see the QBI deduction stay as well. Now, the second thing going on here is that Kamala Harris also announced a new tax plan that in many ways differs from the tax proposal originally proposed by President Biden. She is proposing to provide a $25,000 tax credit for first-time homebuyers. Now, for context, President Biden initially proposed a $10,000 tax credit for first-time homebuyers, so this reflects a $15,000 increase from his plan. Now, the details of how this plan would work is pretty vague right now, but from what I can see, if you have 2 years of good rental history, you could potentially qualify for this tax credit. Now, another big tax proposal in her plan is increasing the child tax credit up to $6,000 for families with newborn children specifically. So basically, if you have a newborn child, you could potentially qualify for a $6,000 tax credit depending on your income. And then for business owners and investors, she is increasing the new business startup deduction to $50,000, which could save business owners thousands of dollars in taxes. For example, a $50,000 tax deduction for someone in a 24% tax bracket would equate to $12,000 in taxes saved. Now, such a big loss could motivate W-2 employees to create side businesses because this deduction could create a loss that then offsets some of their W-2 or other income. Now, currently, the tax law allows business owners to write off up to $5,000 of the costs they incurred to start their business. But if their startup costs exceed this amount, then they would be unable to deduct those expenses in excess in the same tax year, though they could take it in future tax years. For example, someone with $50,000 in startup expenses right now would only be able to take a $5,000 deduction in the first year, and the remaining $45,000 would be taken over the next several years. But under Kamala Harris's plan, you would be able to write off up to $50,000 of those expenses in the first year, which could result in a big tax deduction for qualifying businesses. Now, as a CPA that works with a lot of self-employed individuals, I can already see how people are going to take advantage of this deduction to reduce their income on their individual tax returns while starting their business. And some people with businesses might create a new business to take advantage of this as well. But ultimately, if you're planning to buy your first home, have children, or start a new business, then these are just some of the big tax benefits that you would receive under Kamala Harris's plan. Now, on the flip side, whenever we have tax breaks like this, someone has to pay for it. And Kamala Harris's plan specifically relies on increasing taxes on high-income individuals and businesses. And if that's you, don't worry, I'll also give you some tips to reduce your tax exposure here. Okay, so first off, for businesses, she is proposing to increase the corporate income tax rate from 21% up to 28%. So even if you have a small business, if you operate as a C corporation, then your taxes will increase under this plan. Which means that if this goes into effect, you may want to talk to your CPA about simply changing your entity, because a simple change to an S corporation, partnership, sole proprietorship, or whatever the case may be, may result in lower taxes for you. Now, for larger corporations, we already know what they're going to do to avoid these additional taxes, from setting up offshore entities and setting up companies in countries with simply lower tax rates. But let's also talk about investors. She is proposing to increase the long-term capital gains tax rate from 20% to 28% for individuals with taxable income above $1 million. So even if you strike gold with selling a stock when you're investing, or maybe you're selling a small business because you want to retire, if your capital gain is greater than $1 million, then you will pay more taxes as a result of this plan, which can be a nasty surprise for some people. Now, taxpayers in these situations may consider holding on to their assets instead of selling them to avoid paying additional taxes. Now, the rich, they just use a very common tax strategy called the buy, borrow, die strategy, which simply means that they will hold on to their assets for life instead of selling them to avoid paying taxes. And then they just borrow against those assets when they need liquidity. Now, if you want to learn more about that, I do have a separate video on this channel that describes that, so be sure to subscribe and check that out. But we're not done here yet, so let's talk about her plan for individual tax rates. She is proposing to increase the top individual tax rate to 39.6% on incomes above $400,000 for single filers and $450,000 for joint filers. Now, currently, marginal tax rates are as low as 35% for single taxpayers with incomes above this range, and even as low as 32% for married taxpayers within this range. So if this goes into effect, these taxpayers could pay up to 5 to 7% in extra taxes on their incomes above this level, or another $5,000 to $7,000 more on every $100,000 earned in income. For taxpayers who want to limit their exposure to these higher taxes, then they may want to look at creating tax deductions to reduce their taxable income to lower tax brackets. There are people with millions of dollars in real world income who pay little to no taxes because they know how to legally reduce their income due to provisions in the tax code. For example, you could make tax deductible investments into a business, rental property, or even qualified oil and gas companies. You could even defer more of your income by simply investing more money towards your retirement savings, health savings, or even using charitable saving structures. Now, I have a full video that explains the best ways on how to do this on our channel, so make sure you subscribe to check that out. But if you need immediate assistance, just go over to mycpacoach.com to apply to work with one of my CPAs today.